Hi, this is Alan Gassman, and welcome to our Tuesday afternoon at 5 p.m. conference call on comparing the financial strength and risks associated with different life insurance carriers. I'm here with our guest, Barry Flagg. This will be the last of a number of webinars that we've been giving, but not the last one we're ever going to give on a very, very important and interesting topic. And that is what's going on inside of these life insurance policies, what's going on inside of these life insurance carriers, and what can we as advisors do to improve things, to help clients, and to optimize results. Please don't forget Tuesday, April 21st, How to Handle Stressful Matters in an Ethical Way, Part 2. If you didn't see Part 1, you're welcome to watch it, but you don't need to enjoy Part 2. That's good for one ethical credit hour if you're a lawyer or CPA. May 19 with Juana Tunis, Arbitrating Trust and Estate Disputes. And June 9th, What's So Special About South Dakota? We'll talk about why the Triton Trust Company, which is an international trust company, has chosen to actually come to the United States and use our trust laws in South Dakota. So Barry, do you want to click the slide there? You can, of course, email me at agassman@gassmanpa.com for anything you like whatsoever. Then the next page, if we could, some Bloomberg B&A webinars. As you can see, it includes May 12, 2 p.m., a 90-minute program by Barry, Professor Jerry Hesch, and I on the Tax Advisor's Guide to Permanent Life Insurance and Structuring Tools and Techniques. We would welcome any questions or comments you might have today. And if you would like to get a pass to that program or a discount to get into that program, let me know, and I can ask my friends at Bloomberg what they can do for you. Please also don't forget on the next page, I've got the Florida Bar Annual Wealth Protection Conference, Thursday, May 7th and Friday, May 8th. So please consider that, especially the Fundamentals program on Thursday for anyone you may know. And most importantly, let's talk about our speaker. Barry Flagg is a very, very experienced charter life underwriter, chartered financial consultant. He's a cum laude graduate of the Stillman School of Business at Seton Hall University. He has been on the CFP National Advisory Board's Disciplinary and Ethics Commission. He's been an adjunct faculty member at the College of Financial Planning. He's in Who's Who in Finance and Industry. This guy knows what he's doing. He's very technically oriented. He's very careful when he explains things and presents things. And probably most important is he is the inventor and founder of Verilic, which is a patented online publisher of life insurance pricing and performance research and product suitability information. If you've ever seen a Morningstar report on a mutual fund, you'll understand the importance of looking at a Verilic report on a life insurance policy. So Barry is not here today to sell life insurance or to tell you that he should sell you life insurance. He's here to talk about some technical issues, most importantly being the financial strength of insurance carriers and what that means not only from a potential failure standpoint, but also from a credibility standpoint and from a rate of return on policy standpoint. So Barry, I'm going to hand it over to you now and stay out of your way.
Terrific. Thanks, Alan, for such a kind introduction. So today we're talking about financial strength and the risks associated with different insurance companies as may be indicated by their financial strength. Certainly, considering financial strength has been one of the most common and certainly one of the more important considerations. We'll talk about some reasons why it's important. I think it's been common in large part because in this day and age where Alan mentioned Morningstar ratings, and we've got ratings of bonds, and we've got, for that matter, we've got ratings of restaurants and hotels, that the carrier ratings had been about the only rating that financial advisors could use, and so it was very, very common to rely on the ratings, maybe overly rely on the ratings, because there are many, many carriers, and trying to filter through and find the carriers that are the right carriers. Again, it's such a voluminous process that there needs to be some way of sifting through and rating one carrier over another. However, the financial strength and claims paying ability of a carrier is only one of the 5 major suitability factors. Alan mentioned our research reports, Veralytic Research. We publish ratings based on all 5 of these major factors. So you can know in a report that is designed to be and has been described to be easy to read for non-insurance professionals, it uses common financial terms, you can know how a particular carrier and the product under consideration relates to the universe of peer group alternatives based not only on financial strength but also cost competitiveness, the stability of that price, that cost competitiveness, whether or not you have good or limited access to cash value, and again, like Morningstar, whether or not the historical performance of invested assets and underlying cash values actually supports the expectations being set in a particular illustration. So it's important. Financial strength is a common consideration. It's only one of 5 of the major suitability factors, but it is important because insurance is a promise to pay. So the financial strength provides some indication of the claims paying ability of the carrier. And there are 4 places this comes into play. I'm going to do them in reverse order because while the death benefit, the concern over the payment of the death benefit is, in my experience, the most discussed issue of claims paying ability. To my knowledge, there has never been a death benefit that hasn't been paid. I know that's a double negative, but there's never been a death benefit that hasn't been paid. So as it relates to the payment of death benefits, financial strength claims paying ability has not made a difference in the past. However, we're going to talk about some reasons why that could become more important in the future. The places where it has come into, that it has actually come into play in the past is that certainly there have been insurance company failures and rehabilitations, and while all death benefits that I'm aware of have been paid through that process of failure and rehabilitation, the rehabilitator or the courts have broken some of the guarantees that were originally part of policy contracts. So just because no death benefit has never not been paid, a triple negative, just because death benefits have always been paid, even through rehabilitation and even through rehabilitation, the claims paying ability of the carrier is important because some of the guarantees that you may have purchased could get broken by the rehabilitator or by the courts. In addition, through the rehabilitation process and even afterwards, access to cash values can be limited. Your ability to do anything with the product can be limited or restricted by the rehabilitation process and even afterwards. But the first thing to go in the rehabilitation of an insurance company is the payment of commissions to the distribution system that place the policies. So there are 4 levels of protection when it comes to claims paying ability. The first one really is not a matter of concern for the client. The second, access to cash values and the ability to do something with the product is important. The guarantees, and then obviously the death benefit. But what financial strength may be even a better indicator of, and we'll talk about some examples of this, is that it has been a leading indicator. Changes in the financial strength and claims paying ability rating of a company has been a leading indicator for cost increases. And we'll talk some more about that. This is important, an important element of our research, of the research that we publish. We publish costs, the internal costs of a particular policy holding as it relates to its peer group. Costs are different than premiums. Premiums are a commingling of actual costs with some hypothetical performance assumption. So we as is required by prudent investor principles and the chief regulatory body of the financial services industry, we measure the internal costs, not comparing the hypothetical premiums. Those costs vary by as much as 80%. So there's a 40% swing on the worst side of the average and a 40% swing on the best side of the average. So with our reports, our customers or the clients of our customers or the advisors working with our customers can determine faster than I'm actually explaining it here whether or not they're being charged a fair price, or if they have a report from when the policy was placed and then maybe when there's a rating downgrade, they can measure whether or not the cost has been increased. Because if you don't know what you're being charged, you can't know if they're going to, if or when they increase the charges on you. And then I mentioned when there's a ratings downgrade. The ratings downgrades come from the ratings agencies. There are 6 rating agencies for life insurance companies. They all evaluate roughly the same things, but they do it in a little different ways. And there are 2 different types of rating agencies. There are what are called these NRSROs. Those are the rating agencies that are supervised by the Securities and Exchange Commission, or the SEC, and they're supervised because they issue ratings on securities. They also issue ratings on life insurance companies, but they issue ratings on securities, like a AAA rated bond or a AA rated bond. The NRSRO type rating agencies are considered voluntary ratings. The rating requires the issuer, or the insurance company in our case, to cooperate with the rating agency and to pay the rating agency a fee. This means that the rating agency has access to non-public information, to private documents. They have access to management, so they can, since one of the considerations is company management, they can actually talk to company management, and there's certainly an advantage to that. One of the disadvantages is that the voluntary nature of the ratings makes them vulnerable to shopping. For instance, if a insurer was talking to a rating agency, sharing non-public information, talking about talking with management, and the management feared that some of the non-public information might not result in the rating that they want, or might not want to be made public, they can refuse to cooperate further, they can refuse to finish paying the fee, and so in effect that gives the company the ability to shop for the ratings that they like and to discard the ratings that they don't. And because they're paying a fee, the mortgage crisis brought real question to this about the rating agency being paid a fee by the recipient of the rating, and so that raises questions about the conflicts of interest inherent in being paid to get a higher rating, particularly involving the shopping. And for all these reasons, that's why there's regulation and oversight by the SEC, which I already mentioned. So then there are the NRSROs, and then there are the involuntary rating agencies. They're using only public information. That eliminates some of the problems with the ratings from the NRSROs, the conflicts of interest, the ability to shop, but they don't have the opportunity to talk to management. So they're perhaps not getting as good information as would be available to the NRSROs. But since they both have advantages, there's probably advantages and disadvantages. There's probably some merit to using all of them. And all of them consist of a lesser-known company. This is in alphabetical order, so it just happens to be that the lesser-known company is first. It's a company by the name of Alirt, A-L-I-R-T. Most people have heard of AM Best. Fitch, maybe a little less so than AM Best, or Moody's and Standard & Poor's. And then Weiss is another of the involuntary rating services. And they all rate based on different grades, different nomenclature that they assign to the various creditworthiness classifications that they each have. And at the very bottom, you can see they all have, excuse me, they all have different numbers of grades, whereas Alert has only 7 categories, AM Best has 15, Fitch has 20, et cetera, so on and so forth. This gives rise to some disparity in the way the averages work out. So if you were to just rank all the companies based on all the ratings and put them into an aggregate percentile or top decile or top quartile, which is what the Veralytics system does, the green would indicate the ratings most often found in the top 10% strongest rating companies. The yellow would be kind of in between the top 10% and the top 25%. The orange is between the top 25% and below the top 25%, and the red is below the top 25%. So you can see that if you average everybody out, using one rating might result in a better or worse perspective than kind of the aggregate of all of them, and so there are reasons why the different rating agencies come up with different ratings. So maybe taking an average, kind of diversifying the pros and cons of the different rating agencies, in our view, makes some sense. So when you're looking at ratings, acknowledging that they have dissimilar scales and nomenclatures is an important consideration. Again, don't want to over-rely on a rating that is a good rating, but it may be good for dissimilar reasons than another rating. And so again, it may make sense because of this incongruent crossover to consider looking at an aggregate. At least that's the way we feel about it, and that's how the Veralytics system works. It's also important or prudent to be conscious of whether or not you're looking at the parent company or a subsidiary company, because the ratings almost universally, or at least largely, of a subsidiary are the same as the parent, or at least very similar. But the financial crisis showed us that and I got a couple of examples of this, the financial crisis showed us that as companies are spun off or set off into what's called runoff, where the company is not operating it anymore, the ratings no longer are barred from the parent, and there are disclosures in public documents, public company documents, that even say that the parent has no legal obligation for the liabilities of the subsidiary, even though the ratings give the subsidiary the exact same grades as the parent. So looking at considering whether or not you're looking at a parent or a subsidiary when you're looking at ratings is an important consideration. It's also important to remember that just because carrier ratings, the ratings of the insurance companies, were the only kind of ratings around for an awful long time, it just doesn't mean that a top-rated insurer issues top-rated products in every single situation. In the same way, Fidelity Investments may be a very good mutual fund. Not every single one of Fidelity Investments funds are the best funds in their given peer group. And same thing holds true with life insurance companies, even more so. Financial strength, claims paying ability is one of the important considerations, but it doesn't mean that the product is top-rated just because the carrier is. As I already said, I think one of the things to watch for is to use ratings as a leading indicator of cost increases. We have a couple of cases that provide real-life examples of this. There's a company, not all that talked about now, but that was kind of in the news some years ago, where Conseco had purchased some other blocks of business as part of their growth strategy. As part of those acquisitions, they had inherited some unprofitable blocks of business, and one of the things we're going to talk about is increasing acquisitions. So as more and more companies are acquired by others or merge or change their capital structure by acquiring blocks of business, there are at times unprofitable blocks inside this purchase that the company doesn't necessarily know about until after the fact. And when they have unprofitable blocks of business, and they can only increase costs so far because the State Department of Insurance, Departments of Insurance have maximums that they can charge. And so when that strain puts pressure on the company's profitability or their capital and surplus, the rating agencies can and should be downgrading them. And lo and behold, in the case of Conseco, in 2008, they were placed on negative watch list. In April of 2008, later in 2008, they were issued a downgrade. And then in October of that year, lo and behold, they announced an increase to the cost of insurance charges and expenses, which a number of the policyholders objected to, so they filed a lawsuit. In 2010, the costs were actually rolled out. And then in 2012, the plaintiffs stopped to sue the increases as one example of the fact that ratings can be a leading indicator for cost increases. We wrote about the Conseco case, and if anybody's interested in that, in more detail about that, just send Alan an email or send me an email, and I'm happy to send you a link right to that page on our website. Some other examples, and these again are in alphabetical order, so I'm not picking on anybody. AIG is illustrative of the disconnect between parents and subsidiaries. This one's actually like a reverse disconnect. It was AIG, the parent, that experienced financial trouble during the during the financial crisis with their credit default swaps and mortgage-backed securities, credit default swaps on mortgage-backed securities. And there was questions about the viability of the subsidiaries, but as it turned out, the subsidiaries were the entities that were well capitalized, and AIG parent actually tried to borrow from the subsidiaries. But again, it's an example of how the parent and the subsidiaries oftentimes have similar ratings, but not every time should have the same ratings. Hartford, same idea. Hartford spun some business off, and the business that they spun off, the ratings were downgraded quickly thereafter. Lincoln Benefit was spun off by Allstate to a private equity firm, and again, the ratings went from very high to non-investment grade almost overnight. Lincoln Financial experienced some strain on some of the product lines that they had issued in advance of the financial crisis, and the financial crisis put strain on them. And they actually, the products that they were very popular prior to the financial crisis, actually after the financial crisis, were products that had very strong guarantees. And since they couldn't change the pricing on the guaranteed products because the premiums and the death benefits were guaranteed, they actually announced that they were going to increase prices on other policyholders, which doesn't really seem fair. If the block of policies that's causing strain on them is a different block of policies than the one they're charging, than the policyholders that they're charging the increases to, it doesn't really seem fair. But once again, ratings as an early warning sign of cost increases. Phoenix, another example. Sun Life is an example of the parent-subsidiary disconnect, as is what used to be ING or Secure Life of Denver and now is Voya. So this is important in concept, but it's also important in practicality because this stuff not only can happen, it has been happening. So, we're talking about ratings being an early warning indicator for pricing increases. So if you're about to get a price increase and you don't want to get the price increase, what do you do? Or if the ratings are downgraded, particularly if you're a fiduciary and you have a financial strength and claims paying criteria that you have to maintain, the way, for instance, institutional fiduciaries have a minimum ratings for bond holdings or insurance companies that they can have. So if it goes below that bond holding, what do you do? Well, it's beyond, the answer to that question is beyond the scope of our time today, but there is growing guidance for the things that should be considered when you're considering making a change in a life insurance policy in order to get out in front of a cost increase that's coming or in response to a ratings downgrade. I've talked about these in some of the other webinars. You can listen to them because they're recorded. I don't have time to get into them now, but there is growing guidance. And so if you're a fiduciary or either a trustee or a CPA or a tax attorney or a CFP, there is growing guidance that you can rely on that is different from many of the prevailing practices of the life insurance industry. So I encourage you to seek out the guidance, and if you want some more direction on that guidance, public guidance or public authority guidance, just email Alan or me, and I'm happy to provide it. So I alluded to before that there are some coming risks, or there are some, there are risks that are different from one company to another, and there are also some risks that I foresee coming as it relates to financial strength and claims paying ability. We are currently in a very, very favorable environment for high ratings or higher ratings, at least over the short term. Equity markets have been up, so some of these products that have provided guarantees against loss, the insurance companies have not had to reserve for anything. They've not had to and reserving is an expense to an insurance company. So these guarantees have cost the insurance company nothing because the markets have been up. They haven't had to, none of the guarantees against loss have had to kick in, which is what cost the insurance companies money. To the contrary, actually, some of the hedging activities that they've done have actually made them money. They put the hedge in, which is ordinarily a cost item. They put the hedge in to manage their risk of providing this guarantee. They don't put it in necessarily as a profitable trading strategy, but because of the markets being up and interest rates going down, inexplicably going down when nobody thought they would, they've actually provided insurance companies with unexpected capital gains. All of this, favorable market environment has been so we're in this favorable market environment at the same time that sales have been pretty much flat, and while that sounds like a bad thing for an insurance company, the flat sales for an insurance company, the first year of sales in an insurance product actually are more expense than they are revenue, and so lower sales is good over the short term. And there have been some statutory changes which have been, if anybody follows Joe Belf and the Insurance Forum, or if you'd like to know more about some of these statutory changes that have made it easier to use affiliated reinsurance companies or private captives or limited purpose subsidiaries that provide insurance companies who have the exact same risk but who are allowed to account for that risk more favorably than otherwise. That's I think one of the risks that is yet to manifest itself. I talked before about increased M&A activity and alternative buyers. There's a debate, and I don't mean to imply that there is a inherent answer in this debate, but there's a debate between an insurance company buying an insurance company subsidiary versus a private equity firm buying an insurance company subsidiary. Insurance obligations and operations are long-term in nature. A private equity holding period may be short-term in nature, but then a lot of these insurance companies are public companies where they're looking for even shorter-term results. It's really an unanswered question, but certainly this M&A activity gives rise to, particularly in larger transactions, asking more questions than just the ratings. And we have a couple of insurance companies that have been designated by the Fed systemically important financial institutions, and no one knows what that means yet. No one knows what that means on what an insurance company can and cannot do, or maybe it's just me who doesn't know. But it's a relatively new issue. It's a relatively few number of companies, but that's certainly something that could change. So how do we mitigate these risks? Well, if it's a small policy, there are state guarantee funds that guarantee death benefits up to a limit, guarantee the payment of death benefits up to a limit, and guarantee the payment of cash values up to a limit. It's different in every state, but it's typically $300,000 in death benefits and $100,000 in cash values. So for this audience who has people paying them for advice, they're probably above and beyond these limits. So the better thing to do in larger transactions is go beyond the letter ratings, ask about the parent subsidiary issue, ask about the internal capacity, consider diversification, ask about the use of reinsurance, which some argue is a form of diversification, and I don't necessarily argue against it, but I think it's not automatically in every case a replacement for diversification. And I think it's all the more important to use an aggregate ranking system instead of individual ratings, given all of the risks that are new risks, and so I wouldn't want the opinion of just one on assessing those new risks. I would get some comfort in averaging the opinions of many on something that has not really been experienced before. Financial strength and claims paying ability ratings are a tool for managing risks, a tool for perhaps managing costs. It's an important consideration, but it's only one of 5. I would beware, just because insurance companies, or just because the industry really has had only one rating system for an awful long time, company ratings, I would beware of the top company marketing statements. I know Alan is working on a case that we've discussed, and there's some 40 different products available in that are suitable by category to a particular situation, and the marketing statements were, well, these are the top 11 companies. Well, I'm not sure what top 11 means because it wasn't defined. So just beware of top companies' marketing statements. Top ratings does not mean top products. It doesn't mean that they're not top products. It just doesn't automatically mean that they are.
And also
consider the aggregate rating to reconcile the differences of opinions in the rating agencies. Monitor for potential cost increases. We already talked about that. If you would like to, we publish once a month a ratings alert. So if you would like to get our ratings alerts, you can either go directly to the website. You can see in the upper right-hand corner you can see in the upper right-hand corner the newsletter button. You click on the newsletter, and then down here below where I've got on the screen, down here, there's a place where you can add your email address, and you're automatically added to our ratings alert list. If you want to email Alan or email me, you can also get on that way. So in using ratings, once we determine that there may be a need to make a change because of a rating indicating a potential cost increase, or a rating that's below our threshold for safety threshold for holding in a fiduciary account, some of that guidance that we talked about refers to the appropriate versus inappropriate use of illustrations. it is particularly important. There are now 3 government agencies that have issued guidance on the appropriate versus inappropriate use of illustrations. If you're going to make a change, make sure you're making a change that is not based on what government agencies now consider to be misleading, fundamentally inappropriate, and unreliable. And one of the checklists, if you will, that is designed to help non-life insurance practitioners. It's designed to help the life insurance practitioner apply fiduciary principles too, but it's really designed to help non-life insurance practitioners or life insurance fiduciaries with a checklist for here are the things that you look for in a decision-making framework that's designed to be prudent or designed to comply with or comport with fiduciary principles. So with that, Alan, my time is up, and I'm trying to do a better job of staying on time. Do you want to wrap up with?
Great job, Barry. That was very informative. And also, you know, insurance carriers, they say they have all natural ingredients, but they don't always have all natural ingredients. So you have to be careful, as you said. How often, Barry, have you been brought in to evaluate a number of proposals that a client's looked at and said, you know what, I would take Company A over Company B, even though Company A's proposal looks better, or isn't quite as good as Company B's, they're much stronger financially. How often does that actually happen?
I'm not sure I have a sense for that. But rather, I think it's the way you phrase the question is far more important than how often it happens. I think that the industry has gotten into a habit, and I don't think it's necessarily a good habit, but gotten into a habit that markets a product feature or a carrier feature. The carrier's rated this, or the product has this feature, or whatever. So they start with the product. And I think the way you phrase the question is exactly the right decision-making decision tree. Is what are the things that are important to the client? Certainly ratings is among those things that are important. Cost is among those things that are important. There could be features and benefits that are important. And then laying that out and saying, okay, Mr. Client, you've got or Mr. Grantor, or the beneficiaries, this particular product has costs on file with the State Department of Insurance, not the hypothetical illustration or hypothetical premium, but costs on file with the State Department of Insurance that are 20% less than carrier B. But the ratings are not in the top decile, they're only in the top quartile. And then you have that conversation with the client about what's more important to them, lower costs or higher ratings. I think you framed that question exactly the way it should be framed, and that it's not framed that way often enough.
Thank you very much, Barry. If anyone has any further questions, please feel free to email Barry. You've got his email address right here on the screen, bflagg@verilic.com. I'm Alan Gassman, agassman@gassmanpa.com. We welcome your questions, comments, and suggestions for both this presentation and future presentations. Have a fantastic evening. Onward to the cocktail hour, or at least may the rest of your time be billable. Thank you.